And some of you seem pretty shy. And so I understand if it's a security safety kind of thing, you cannot turn on your camera, feel free to keep it off. However, if you're sitting there, even if you're eating, I don't mind. Okay, so turn on your camera. That's totally okay. Or Kevin, in your case, you're doing daddy duties. So that's totally okay. You know the drill. Because if this was real life in person, physically, you could be doing the same thing too. So I don't mind that whatsoever. Now, if you don't have pen and paper already, I highly encourage that you do, because I'm going to be asking you to take quite a bit of notes, simply because of the fact that when it comes to learning how to invest, or the language of investing, for many of us, it's kind of like reprogramming some of the old investing concepts, mindset, ideologies, or even just thought process. So the more you take notes, the more you write, the more the new knowledge is solidified in your own brains. And that way it becomes more of a second nature when the time comes for you to find a deal, to analyze a deal, to structure a deal, and to execute on it. Okay, so if you now need a couple of minutes to go and get pen and paper, now is your time. With that said, though, while you're doing that, I'm just going to get the boring stuff done and out of the way, because my lawyers love me a lot more when I do this. Simply the fact that we got to show you some of the disclaimers, because at the end of the day, I am not a licensed mortgage broker. I am not a realtor. I'm not an accountant, not a lawyer. Again, I mean, my parents really would have wished that I was a lawyer or an accountant of some sort. At the same time, you know what? It is okay, because as a professional investor now, they actually work for me, or we work with them. Okay, so that's totally okay. I would much prefer it that way. Now, a lot of that was all legalese. I want to just break it down quickly in plain, simple English. I don't know if you know about this. English is not my first language. I didn't start speaking English until I was 17 years old. And so a lot of the times, even legal jargons, they don't make sense to me whatsoever. And that's why I'm a big fan of making sure that things can be easily understood. And so with me, I think that's pretty much guaranteed in a way, because I don't use a lot of big words here. I just use my words so that people can actually understand what I'm wanting to say. And so as I mentioned earlier, really what I'm focusing on is the fact that I'm going to be putting on my investor's hat on. Okay, I'm going to be putting on my investor's hat tonight when it comes to sharing this webinar with all of you. And I hope you're okay with that. And with that said, not a financial planner, not an accountant, not a tax advisor, not a lawyer, or anything like that, as I mentioned. Strictly, I really want to share with you, because I believe that this is what everybody is here at the seminar for. Okay, I'm here as an educated investor and a longtime real estate investing mentor and coach in this industry. I mean, I've been doing this professionally for 13 years now. And prior to that, I'm just going to say, I think I started in real estate, or purchasing real estate, in 2004. However, I want to make sure that everybody understands the fundamental difference here, especially at Trust Your Talent. I always say this, and if you want to make a note of that, feel free. This is not a must write down thing. However, listen up, okay? Very much like all thumbs are fingers. All thumbs are fingers, but not all fingers are thumbs. Yes, we can all agree with that. Let's test your emojis, or just raise your hands so I can see you on the screen. Okay, everybody understands that. Awesome. And so at the same time, I want to say this. All investors are buyers, but not all buyers are investors. All investors are buyers, but not all buyers are investors. Can everybody tell me what that means now? I just shared with you, I actually purchased my first property back in 2004, so nearly 20 years ago now. But I said I bought it simply because that property was actually in Burnaby, BC, and I moved to Edmonton in 2009. When I decided to move to Edmonton, I actually rented out that first property. It was a 2-bedroom condo. I bought it as a pre-construction in 2004. At this point, as a professional investor, I cannot even begin to tell you how many things are wrong with those sentences. Okay, so that's a different seminar altogether at this point. However, the point is, I was a buyer and I was an uneducated investor, because when I decided to hang on to that property in 2009, because I was moving to Edmonton, I rented it out. And when I was renting it out, I was not cash flowing on a monthly basis. In fact, I was in the negative. However, I thought that was okay. And then very quickly, I learned that that was one of the most financially idiotic and unsustainable things I could have done when it comes to my own bottom line. And that was simply because of the fact that I was just a real estate buyer and not a real estate investor. And this is why there's a fundamental difference in how we approach the subject of real estate investing at Trust Your Talent here. So I want everybody to understand that first and foremost. So with that said, throughout the entire evening, I'm going to be sharing with you, as an educated investor, as a professional real estate investor, leveraging real estate investing as my main vehicle to create income sources and wealth in the long term. Is that okay with everybody by a show of hands? Good. You can use your emojis, okay? And I know a couple of more people just popped in. I want to say this, turn your camera on unless it's a safety concern, okay? If you're driving right now, don't worry about it. However, if you're doing anything else, maybe if, answering the call of nature, you don't have to turn your camera on either. However, let's say if you're having dinner, because it's usually dinner time right around this time, okay? It doesn't matter what time zone you're in. Please turn on your camera so that we can make this as engaging and interactive as possible. You've made the time already. I'm going to give you everything I got. So give me everything you got back. All right. So now that you got your pen and paper handy, I'm a big fan of making sure that you are present, because as investors, one of the biggest things we always focus on is a phrase called ROI, or an acronym called ROI. What does ROI stand for? Unmute yourselves or type in a chat box for me. What does ROI stand for?
Return on investment.
Return on investment. You are investing your time here. Thanks, Suzanne. Your time is the most valuable commodity and resource that you have at your disposal. You're investing that already to be here. I want you to get the most out of it. Does that make sense? Yes or yes? Okay. Give me a quick nod. That's all I need. So right now, I'm going to give everybody 2 minutes to do what we call a little mind dump exercise. I know life doesn't stop just because you're on a webinar. I understand that. At the same time, though, do your best. Do yourself a favor. Give yourself the clarity so that you can absorb as much as possible. Because I understand it's one of those things that sometimes you just listen to it and you miss a couple of really crucial points, and the rest of the content does not make sense anymore. I really, really hope that that doesn't happen to too many people. It still happens. However, I'm going to give you 2 minutes right now. I'm going to play a quick song. And when the song ends, that means your pen goes down. Okay. What are you writing down on your mind dump exercise? Oh, I need to pay my hydro bill. I need to pay my cell phone bill. I need to pay my Visa bill. Oh my God, I need to drive my kids to school at this time and they have a play date. Oh, shoot. You know what? Tax deadline was yesterday. I don't think I filed completely yet, or I need to check with my my accountant. All these things that are happening, especially if you're already active in investing right now, you may have a ton of things going on. Park it all. You will revisit it after the seminar is done. Deal? Okay, 2 minutes. Ready? 1, 2, grow. There we go. All right. I hope that you got a decent list going and that is now on the wayside. So first thing first, I want to share a little bit about who Trust Your Talent is in case you've never been to a Trust Your Talent webinar series yet. And really, Trust Your Talent is born out of this very concept. Having been one of the co-founders for Trust Your Talent, I'm super proud of the community and the family environment that we have built to support each other in our journey in pursuit of financial wellness. And so this is really what Trust Your Talent is all about. We started this organization, this company, this business, this training institute to help make a difference in people's lives. Our fundamental 5 core values at Trust Your Talent here are health, And that is not just physical health. It's financial health, it's physical health, it's emotional, mental, and spiritual health. And then we have sustainability. I see, Kevin, your name has sustainability in it, which I love. That personally is also the core value that I am focusing on this year. And number 3 is joy. I love doing what I do every single day, and that is investing for a living, having the time and the financial freedom to do anything I want, whenever I want, however long I want. This is the first day back in Edmonton after 7 weeks on the road. This is literally the first day back. And I am so happy to be home. At the same time, I'm also very grateful for the lifestyle that I've been able to build because of a cash flowing portfolio. Actually, a few cash flowing portfolios, but we'll get into that later. And the 4th core value is fulfillment. Because you might be happy doing something for a short while. In the long term, if you're not finding that sense of self-fulfillment, it may not be sustainable. And you can start to see how even within the core values, they do tie together, and there is a loop there. And last but not least, our core value, the 5th core value is impact. And this is exactly why we started Trust Your Talent. And this is one of my favorite quotes of all time, said by Sir Richard Branson. Everybody knows who Richard Branson is, yes? Okay, the CEO, founder of the Virgin Group. He owns and controls a lot of different businesses. When I grow up, I want to be just like him, because I understand that every single business that he builds, he brings his own authenticity, his vision, his purpose to help people and to help leave the world a better place through his businesses. And so if you aren't making a difference in other people's lives, you shouldn't be in business. It's that simple. And really, it is that simple. Through helping others, and I love the fact that we're talking about lease options tonight. Through helping others, it has helped me set up a very strong financial foundation to build a lifestyle that I've just described with everybody tonight. So with that said, if you really want to get to know who TYT is, our vision statement is to elevate human potential by living a strategically positive life. I know to some of you, if you're not quite sure what that means, it could sound very abstract, kind of like a Picasso painting. You're looking at it, you understand the colors, you understand the words, however, you don't know how to interpret it. And that's totally okay, because once you're part of the Trust Your Talent community, over time, you will understand it more and more. Now, the mission that we're on right now is to create financial independence one person at a time. Because when it comes to the financial wellness core value, we know that even though money isn't everything, it does help with a lot of things in life. Can we all agree on that? Yes or yes? Okay. The funny thing is, one of my best friends from university, this phrase somehow left a mark with me. I once heard my friend's mom said, if it's a problem that money can solve, you don't really have a problem. Okay? I'm going to say that again. If it's a problem that money can solve, you don't really have a problem. I think that speaks to how powerful and how useful the tool of money is. And that's just it. At Trust Your Talent, we really see money as a tool, if for nothing else. Now, with that said, though, we understand life isn't always as easy as we planned for it to be, and that's totally okay. However, I just want to get a sense of why everybody is here tonight by answering this one simple question. By a show of hands, if you want to no longer have to worry about money for the rest of your life. By a show of hands, if you no longer want to have to worry about money for the rest of your life. And I think that unites us all. Okay, that's actually how Ray and I started. My husband, the other co-founder of Trust Your Talent. And we just simply realized that I grew up in what I would call a lower middle class family. And Ray grew up almost on welfare. We were on a very, very simple trajectory to work our butts off, working our assets off, if you will, clocking in 80 hours a week, and never felt like we were getting ahead. And we just realized that something had to change. We had to do something different. And that's also why when we hear about the definition of insanity by Einstein, it says insanity is doing the same thing over and over and over again and expecting different results. And that's exactly what we were doing. We were working harder and harder, hoping to get better titles, bigger promotions. And yet it's still the same formula. Somehow we always thought money was going to solve everything, or hard work was going to solve everything. And then we very quickly learned that that wasn't the case. And so with that said, though, this is really who Trust Your Talent is. Right now, what we're focusing on, as I mentioned, is financial wellness. And when it comes to financial wellness, we want to deliver and help you create that through financial education. Because once you're financially educated, you become financially empowered to make smart money decisions so that money no longer becomes a problem for the rest of your life. You are going to see money very differently over time. At the same time, though, I do want to put this out there with everybody. Simply because of the fact that the asset class that we've chosen is real estate. It's slow moving. So slow is good in the sense that for many people who may be a bit more risk averse, slow movement is great, okay? The other reason being real estate is what we call a hard asset. It's tangible. You can see it, you can touch it, you can visit it if you want to, you can be in it, you can be out of it. I think I made my point here. So for a lot of people, like what we were brought up believing in, which is what? Seeing is believing. And that's why real estate remains one of my absolute all-time favorite asset classes to invest in, and more importantly, to create income sources and long-term wealth with. And so with that said, today, I'm going to walk you through a very, very key and core concept about how educated real estate investors think and behave. Now, the funny thing is, because so far we're only leveraging real estate. However, this is really the educated investors' thought process. And you're going to hear me say thought process a lot throughout, simply because at the end of the day, it's really what counts. Okay, I know these days we get laptop, we get computers, we get spreadsheets, we get fancy analysis tools. Lots of people want that, and these are the things that you will get when you go and take all your courses. And some of you are already TYT students. You understand what I'm saying. However, at the end of the day, the point is, if you want to scale and grow in different markets in different countries, the thought process is first and foremost the most important thing. Now, when it comes to educated investors approach, first thing first, who here is a property collector? Meaning you want to buy property just for the fun of buying properties? Not really. Nobody wants to put their hand up because all of a sudden you're like, hang on a second, there's toilet issues, plumbing issues, maybe floods, maybe natural disasters, maybe bad tenants, not paying rent, damaging the properties, annoying neighbors. All these problems start coming up. So I know for a fact that none of us actually chose real estate because we're going, oh my God, I love my real estate. I want to hug my buildings to sleep every single night, right? We all started with what? We all started with the idea. And I just asked you the question that we no longer want money to be an issue. I remember laying awake at night, wondering why I'm not getting ahead. How am I just paycheck to paycheck? Or better yet, oh my God, they are delaying my bonus payment. So I'm not able to pay that bill that on something that I've already pre-bought. Okay. So we all started with a vision and a goal, and this goal is a financial goal. It is a number. It is a number. So for many, many of us, okay, the number is what we call financial freedom. I'm going to stop sharing my screen so that hopefully I'm going to spotlight myself. That sounds weird. However, the idea is you can see my flip chart. Like I said, I'm very old school. So if you can see my flip chart completely, give me a thumbs up. Use your emojis if you need to, or turn on your camera, okay? Awesome. Good, good. For many of you who have been in TYT, you know this is a bit of a review. At the same time, though, I want this to sink in because this is so core to every investor's mindset and long-term growth building, okay? Because when we said you're financially free, what does that mean? Well, first thing first, I'm going to take you back to what I call the wheel of wealth. Wheel, not wheel of fortune, wheel of wealth. So what that means is this entire circle, or some of you, if you're, more of an engineer type, it's a pie chart. I get it. It is a pie with a peace sign in it. However, we usually say that the circle of wealth or the wheel of wealth is made up by 3 different income buckets. Okay, if you've never seen this before, make sure you're copying this down. Or better yet, this recording is going to be put onto YouTube once some of the stuff has been trimmed out, okay? And so that you can rewatch it. Or I'm going to share different ways depending on how you prefer to consume education and knowledge. I'm going to share different ways for you to review some of these concepts. First income bucket is what we call earned. The second one is what we call passive income. The third one is what we call portfolio income. Okay. Now, earned income, portfolio income, most people have them. Most people have them. What I mean by that is if you have a what we call JOB, just over broke, you have an earned income. Chances are you're trading hours for dollars. However, how many hours a day are there? 24. So what that means automatically is that your earning potential is capped by how many hours you can actually work. Okay. And so that's that. However, we're not knocking it. I want to make sure that everybody understands that Trust Your Talent, we're not one of those organizations that said you have to quit your job. Okay. You have to build complete financial freedom and walk away from your bosses. That's not what we're saying. Remember the 5 core values. Some of you might actually enjoy what you do, and that's okay, especially if you already make good money from it. If you don't, different story, different discussions with your mentors later. However, earned income, most people have them because you're trading hours for dollars. That's fine. And if you're somewhat diligent, kind of like me, good old Chinese boy, if you make $1, you only spend 50 cents, and then the other 50 cents would go into building what we call portfolio income, and that's usually putting money into savings account, RSPs, TFSAs if you're Canadian, and any other forms of investment. So maybe if you save up enough, you start buying real estate, or a lot of people, they tend to go into stocks. Okay, that becomes portfolio income, and that's why portfolio income a lot of the times is also called equity income. Now, the worst part about all of this is portfolio income tends to get taxed at the highest tax bracket, especially in developed countries. Now, I can see in this group right now, I'm going to say only Lisa is from the US at the moment. Everybody else is Canadian. Yes? Okay, if you're Canadian, give me a thumbs up, even just using your emoji. Eric, I don't know where you're from. However, let me know you're there, okay? So, what most people are actually lacking is what we call passive income. Passive income, so many different definitions. However, my favorite one is doing the work once. Doing the work once. And you just have to maintain what you've done and the money keeps coming in. So again, when it comes to earned income, you work 40 hours, you get paid 40 hours worth of work. With passive income, you might initially work for 40 hours. However, after that, you may only have to work an hour a week, and that income continues to come back in. Depending on how far along in the journey, for example, me and Ray, we probably spend about 4 to 10 hours a month on maintaining our portfolio now, at the very most. So it's not residual, it is still passive. Passive just means that you're not actively pursuing it and the money keeps coming in. I know there tends to be some misconception about what passive income is. It just means that you've really freed up your time to do a lot of other things that you want to do other than just work. Okay, so passive income is what most people are lacking. And when we say financial freedom, it means that your passive income has now exceed your basic expenses. Your basic expenses. And that's what I call financial freedom number 1. Okay. Your basic expenses are things like mortgage payment. And if you have a mortgage payment, that probably means you have property taxes and property insurance you got to pay. And if you don't already own your own place, you're renting, that's totally fine too. Your basic expenses would include rent, your utilities, cable, cell phones, grocery bills, transportation, maybe you got a vehicle, you got a bus pass, whatever it is. These are the basic expenses that keep people in the rat race. They got to keep showing up to work so that they can pay these bills. This is why at Trust Your Talent, definition matters. It matters a lot. Why? Because it gives you clarity. It gives you clarity about the goals you need to hit so that you can live the life you want to live. I'm going to say that again. Definitions matter, not because I'm a dictionary. It's because it gives you clarity. So many people, when I first talk to them, what's your financial goal? Let's say when you embark on this journey to invest in real estate investing. Well, I want to become financially free. Great. What's your financial freedom number? Oh, I want $100,000 a month. I'm not saying it's not impossible. I'm just saying that that's probably not your first goal. What we want to do is build the steps to get there. Because after all, it is a process. When you trust the process and follow the steps that we set out for you, it makes it a lot easier for you to accomplish what you need to accomplish, financially speaking. So remember, you never have to worry about money again for the rest of your life. So basic expenses is step 1. Step 2 is what we call income replacement. Income replacement. Why? Because our JOBs tend to pay all of us just enough to pay our basic expenses. And in addition to that, give us just a little bit extra so that we have a bit of a lifestyle. So we can travel, we can go out to eat, we can go shopping, we can go to birthday parties. At the same time, though, again, it's still money in, money out. And it's hard to get ahead that way. I remember in my mid-20s, I was already making 6 figures. And I still never felt like I was ahead of the game. And that was exactly why. And so that's why for most people, their financial freedom number 2 is when they can replace their active income. Then they start to feel really, really good. Now, financial freedom number 3 is what we call, it's too long to write, so I'm just going to say this, is what we call the do whatever you want, whenever you want, for however long you want, and with whomever you want number. Okay? All right, I want you to let that sink in just for a little bit. Because we're not talking about pipe dreams here. We really aren't. You got real life people like me that came from very little to nothing. Went to school, followed the old school path, worked really hard, and still not getting super ahead. And so this is what we've managed to accomplish for ourselves. Can we do more? Absolutely. There's no limit once you're financially educated. And so with that said, this brings us back to what the educated investor's process is figure out your financial goal. So right now, I'm going to give you 30 seconds to ballpark all of your basic expenses, okay? I'm going to give you 30 seconds to ballpark all of your basic expenses so that you have a very clear baseline in terms of what you want to hit. Okay, ready? 1, 2, grow. Okay, I'm not going to get everybody to share here. I'm just going to say this. On average in North America, average household monthly expenses will come up to anywhere between $4,000 to $7,000. $4,000 to $7,000. If you're below that, good on ya. That probably means that you run a pretty tight ship and you're very financially responsible. However, if you're above $7,000 a month as a household, that means you are definitely on the high end. And one of the things that your mentor typically will do with you is to really break down why that is. And then all of a sudden we find out when we do that is some of our students really enjoy their Starbucks in the morning. So that adds up very quickly. If you want to count Netflix as your basic expenses, that's another conversation also. Okay, especially if you're learning how to become financially free for the first 1 or 2 years right now. So with that said, I just want to make sure that you have that clarity for yourself, especially when you now know the definitions. Okay, so moving forward, once you got a goal, the next thing is, if you're leveraging real estate investing, the next step is what we call the SMP process. SMP, I know looking at the screen, most of you already know this or have heard of this. It's proprietary to Trust Your Talent Academy. I know oftentimes, what I like to say, often imitated, never duplicated. Okay, you heard it here first, and this is where it was born. The SMP process stands for strategy, market, and property. Even though real estate, meaning properties, is our chosen vehicle, investment vehicle, and asset class, it is still the last thing we look at, because you got to have a plan, you got to have a strategy before you do anything. And that's also why lease options tonight is a strategy. And then once you've chosen your strategy, then you find a market or markets that will back your strategy, meaning giving you the financial results you're looking for so that you can very directly create the financial results that you want, okay, achieving your financial goal. And then we look for properties, okay? It is very, very contrarian, and that's actually from one of my favorite investor of all time, Warren Buffett. He says, when other people are greedy, be fearful. However, when other people are fearful, be greedy. Now, in the chat box or unmute yourself, let me know, do you think the general public right now is greedy or fearful?
Fearful.
The general public right now is fearful. And as a result, if we were to learn, take a lesson from the greatest investor of all time, we should be greedy. However, greedy, not in the traditional sense, okay, that we're greedy at all costs. No, greedy in the sense that you want to have a thirst and hunger for the proper way to create wealth while other people are fearful about what the market's doing right now. Okay, so with that said, hopefully you're very clear about how we approach the entire process. And I'm going to move on now. I know some of you know about this strategy. Some of you may have already executed the strategy once or multiple times. Some of you have never done it, never even heard of it. So it is my job right now to bring everybody up to speed, okay, so that we can run together afterwards. So bear with me here. I'm going to take everybody back to the basics. So a quick definition for you. Lease options. I want you to think of it this way. It's actually two different words put together. Some of you are going, yes, Tim, I know you're ESL, and I know it's two words. However, what I mean by that is from a strategy perspective, more importantly, I'm going to use my $10 words. From a legal perspective, it is lease with the option to do anything. However, in this case, we're going to leverage the option to purchase to demonstrate the principle. So once again, it is a two-parter. There is the lease component, and then there's the option to purchase component. And so a lease gives you the right to rent out the property, which we probably all know at this point, given that you're at a real estate investing seminar, okay? And then an option gives you the right, but not the obligation. That's the most important part here. An option gives you the right, but not the obligation. Think about that. That is very freeing to buy or do whatever you want. And this is what I mean by option to do anything, except that in this particular case, we are leveraging the option to purchase or option to buy as our exit strategy, meaning we are offering people the option to buy from us. And so at this point, I want you to write this down. Option to buy. Us offering the option to buy, meaning we are offering them what we call the first right of refusal. The first right of refusal. Okay, that's a phrase that you can use and carry with you when you're doing meetings with power team members or potential clients that will go into a lease option where you are the investor. Okay, I also want to make it clear that a lease option should be, when done right, a short-term strategy. Most lease options run between 2 to 4 years these days. When I first got into leveraging lease options, 2-3 year programs were very, very common. However, with the elevated prices of properties as well as interest rates, most of the times, most programs will take 4 years for everybody, for all parties to exit comfortably. Okay. So it's a short-term strategy. And what is short-term strategy? Going back to, we buy and sell to create capital so that we can buy and hold to create wealth. So long-term strategies is where the wealth is built over time, long-term wealth. However, a short-term strategy can help you build some short-term capital, so short-term wealth, then you can recycle the capital that you've built into bigger, longer-term projects. Okay? So with that said, a bit of a background on lease options. I know these days, a lot of you have heard of the phrase rent to own. Yes. Rent to own technically is the street name, or that's what I call it, the street name for lease options. Okay. At the same time, I want everybody, anyone that's been trained by Trust Your Talent, you know, we are very big on technical terms. First of all, that's what makes you stand out as a true educated and professional investor, because you know what you're doing. And the other thing is, by reminding yourself of the technical terms, you will never ever make a legal mistake that will jeopardize your opportunity to succeed. And more importantly, your tenant buyer, and I'm going to get into that in a little bit, your tenant buyer's opportunity to succeed. Okay. Now, lease options traditionally was more common in bigger deals. So these are your land development, these are your bigger commercial, they could be big buildings, small buildings, malls, doesn't matter. Okay. And they were actually used as an acquisition strategy. Speaking of which, I'm not quite sure if you guys are going to the multifamily conference at the end of the month in Toronto. I'm going to be one of the speakers there, and the strategies that I'm sharing is a rolling lease option that I did back in 2013 in Texas, buying 3 mobile home parks when we had very little resources. Okay. And so this is why I said that this strategy typically has been used as an acquisition strategy on bigger properties, because ultimately speaking, it is a creative financing strategy as investors. That's what we call it. However, now when we bring it over and leveraging single family homes as an investment strategy, it's basically what we call a worry-free rental program. What do I mean by that? Well, remember earlier we said nobody really enjoys real estate that much, especially when you got to deal with tenants and rentals and properties, right? Because there's wear and tear, there's potentially bad screening process, you get not so good tenants, worse yet, you get professional tenants. And so there's always a lot of worries that come with choosing real estate as our main investment vehicle. However, in this particular case, with this strategy, it is usually a worry-free rental program. Because why? The people that are renting your place, they are renting it because they have the goal to buy it from you from day one. Their mindset is already different. What that means, typically speaking, is the management portion as the investor, as the owner, as the landlord, the duties of management get cut down a lot, sometimes even down to nothing, as long as you make it very clear to your tenant buyers, because They want to make sure that this property that they are buying and taking over at the end of their lease is in good shape. And this is why so many educated investors, real estate investors, love this strategy, myself included. And the best part about it all, really from a money standpoint, is that it provides multiple ways to generate money, income sources, and ultimately profit for all of us. And it is a win-win because this strategy is so popular right now because so many people are not able to get into homeownership anymore. A recent study has shown that over 64% of the millennials in Canada alone have severe doubts that they will ever get into homeownership. However, for educated investors, what does that mean? It spells opportunities. Okay. Last but not least, this is really important. If you don't take anything else away on this slide, I hope that you take away the last point here. Lease options is a type of creative financing. However, I want you to see it as an alternative lending solution or an alternative financing solution. Why? Because we are the ones as the investors offering this service, this rent-to-own or lease options program to our tenant buyers who are not able to qualify traditional lending. And as a result, they are seeking alternative lending solutions to help them make their dream of home ownership come true. Okay, is that clear for everybody? Give me a thumbs up or by a show of hands. Just let me know. The dots connected there. Yes? Okay, I need some energy here. I don't know what's happening. It's an interactive seminar. You're not watching a pre-recorded session. I can see you somewhat, okay? So let me know if you are stuck on anything. This is your chance to clarify because I'm here live with you. You're not talking to a robot, okay? Now, with that said, two main approaches when it comes to tenant lease options. First one is tenant first. Second one is what we call property first. However, you can see the pros and cons here, and that's what I said. Property first, typically speaking, you use it as more of an acquisition strategy. Now, if you're leveraging single-family homes as your main property type to execute this strategy on, then it's typically an exit strategy at a very lucrative one at that. So earlier, I did mention that this strategy has been super popular over the years, and it's actually becoming more and more popular as their interest rates go up. And so that's why it's in demand. And why is it in demand? Because we have all these categories of potential candidates that are not able to qualify through traditional lending that are very driven by the idea of obtaining home ownership. And that's where we come into play as educated investors offering this solution. So you get your self-employed people that have maybe bruised credit history or really trashed credit history at this point, or they're new to the city, new to the country. Sometimes they basically just move between provinces or states and they want to keep their original property, but they don't have enough qualification based on the high stress test level right now. So they want to make sure that they grow some roots. So that actually also works. It's not just for immigrants. Now, speaking of immigrants, personally, that's where I found a lot of success when I execute this strategy, simply because of the fact that it's harder for them to qualify for anything to begin with, okay? Or more commonly, not enough savings towards down payment of a traditional purchase right now to qualify for lending. And overall, it's just gotten so much tougher. Can we all agree on that, even as investors, to qualify for loans with banks and lenders? Yes, absolutely. Or better yet, first-time home buyers. There's so many first-time home buyers. Remember, even though they highly doubt, 64% of millennials highly doubt that they're able to ever become homeowners, there's still hope there. And so that's where we come in. And last but not least, really the general lack of financial education in the general public. And so this is why education is key. Get yourself educated so that you can share the wealth of knowledge and your solution with the rest of the world. And so right now, I want to walk everybody through a very quick calculations. If you've never seen this, don't worry about it. Like I said, at the end of the session, I'm going to share with you how you can listen to this again and maybe even participate in another session so that you can get good at it. Better yet, speak to a strategy coach after this webinar. Okay. Now, the example that I have set up for you here is going to be something that I think if you're Canadian, you're going to be like, hang on a second, where does that happen? However, before we get into that, because we're looking at numbers, as investors, we always want to know how we're going to make money and how much money we are going to make. I'm going to say that one more time. The full sentence is, your exit strategy determines how you make money and how much money you make. And so right now, the strategy is lease options. Lease options is going to determine how you make money. And this slide here explains how you make money in 3 different ways. Basically, what it means is upfront, during, and at the end. So what that means also if we go back to the wheel of wealth here, you are able to make money in all 3 income buckets. And I'm just going to tell you right off the bat right now, there isn't another strategy in our course curriculum that will hit and feed into all 3 buckets in one go other than this one. So if you're thinking about how to make money and how to make sure that you build a solid wealth portfolio, you should be dancing or screaming on the inside right now, knowing this right now. Okay, so upfront, during, and at the end. So you get the deal done, close it, get possession, you're going to pocket some money. In between, you're going to be making a monthly cash flow, which we love because cash flow is what pays the bills. And then at the end, you're going to have a lump sum cashing out as well. And so with that said, how does that actually work in real life? Because theories are great. And this is why I trust to tell and we have all the courses. At the same time, though, one of the most important components is the mentorship portion of it all. It's the fact that you now got to have somebody hold your hand and execute everything you've just learned in the real world. And that's really where most people stumble. So again, as I mentioned earlier, if this is your first time, don't worry about following along. If this is not your first time and you want to do a recap or just challenge yourself a little bit, do that. Start copying along the way. Now, with that said, though, even if you don't have this app, just make sure that you make a note for yourself. I know most of us are Canadians here, 2 Americans now, so that's totally okay. Because even if you want to use the same app to calculate things, it actually works in your favor. So the app that I'm going to be using is what we call the Canadian Mortgage app. It kind of looks like that. Oops. It's got a little house with a maple leaf flag on it. Sorry, maple leaf symbol on it. So make sure you download the app if you don't already have it. If you have it, open it up so that you can follow along. Okay. Once you get in there, make sure you put in, you click on purchase calculator. So first thing first, when it comes to this strategy, it is all about making sure that your tenant buyers are successful. What does being successful mean for them and for you? Well, for you, you're going to see the result in a little bit financially. For you, it means that you get to make the money that you're going to make from day one. For them, it means that they successfully assume title of the property and through the lease and option to purchase process. So they need to be able to exercise their option to purchase and actually buy you out. That's what qualifies as a successful lease option. Okay. And so what that means is if that is the end goal, even when we're doing calculation, we're going to start with the end goal in mind. What that means is if the tenant buyer right now, and we call them tenant buyer because they're a tenant, because they have a lease with you. They have a first right of refusal to buy, so they're a buyer. Hence, it's a hybrid term. We call them tenant buyers. Not rocket science, right? So your tenant buyers is now qualified for $580,000 as the purchase price in 4 years. Hang on a second. Okay, if you like, take a picture. You know how live this is? I literally updated these numbers right 10 minutes right before we were about to start. So I'm running numbers with you for the very first time. And this is as real as it gets. Why? Because in real life, sometimes this happens. We've met tons of tenant buyers just at Starbucks, at Tim Hortons for the very first time, and we are actually running numbers with them to make sure that they are eligible, so we don't waste anybody's time. So with that said, if in 4 years' time they're qualified to buy for $580,000, okay, and you're in a market where the annual average appreciation of properties is about 4.5%. We're not going crazy, okay? Because that market can be appreciating at 5%, 8%, 10% a year on average over the last 10, 20 year span. We're just going to do 4.5 right now, okay? I don't want you to guess or try to figure out where this market is. I want you to understand the thought process on how the numbers are run first. Remember, S&P. Then you find the markets that'll feed into that. Can we all agree on that? Yes? Thumbs up? Awesome. So I want you to take your calculator now, follow along. $580,000 in 4 years. Every single year, it's 4.5%. So what that means is now we gotta figure out how much is that property worth today? Meaning, what is the maximum purchase price we are gonna put into it today? Is anybody gonna buy that property for $580 today and sell it back at $580 4 years from now? No, right? Okay, so we're all on the same page. So take out your calculators. $580,000 divided by 1.045, 4 times, because 4 years, okay? So you do it 4 times, you're gonna get a number that says today's max is $486,365. For demonstration purposes, and this is also a business decision that you can make later on during or after your mentorship, how you want to deal with that number. But I'm just gonna say 486,000 is today's maximum purchase price. Okay, but with that said, I'm gonna go to the next component in terms of figuring out what the end piece looks like. Now, this is our piece. However, the end piece, really, what's important is the fact that most of these people, when they come for help, our tenant buyers, they have challenges qualifying simply because there are 3 components, once again, 3 different components that they have to hit to get qualified. And that's what we call income credit down payment. Income credit down payment. Either one of those factors or all 3 of those factors do not meet the criteria for them to get traditional lending. Income credit down payment, you want to write that down. Either one or all 3 criteria do not meet. And so we want to make sure that they do meet the criteria so that 4 years from now, they can successfully qualify for traditional lending and buy us out so that our big payday actually happens. So with that said, if they are deciding to buy the property at 580, what we want to do, we know, especially in Canada, in the US, very, very similar. They say that if it's your principal residence, which in the lease option scenario, it 100% of the times is and should be, that means they need to put down 5%. However, do you think the government may change the rules between now and 4 years from now? Maybe they say, 5% is a little too little. So as investors, this is the business decisions that we've made, typically speaking. You can make your own. However, for demonstration's sake right now, we're going to say we're going to help our tenant buyers save up to 10% final down payment. However, that final down payment actually is what we call a total option consideration. Total option consideration, because they have an option to purchase. So that's option money. So I don't want you to get caught up with the jargons right now. Just follow along. So their option money in total needs to be 10%. So if they're buying at 580,000, 10% of that means 58,000. And if you took a picture of the slide, you will know that right now they have some money, just not enough. They have saved up $22,000 that they can fork out right off the bat to get into the lease option program with you. And so what that means now is there is a shortfall of 36,000 that they got to make up. And it's a 4-year program, meaning 48 months long. So every single month, we got to help them put aside some extra cash. Okay. So now 36,000 is the difference. Divided by 48 months, you get a nice clean number at $750 per month as their monthly option consideration or monthly option money. Okay. Now, in this case, we always say as investors, we don't do buy, rent, and pray, especially as educated investors. What that means is every single property is treated like a business, and like a viable and sustainable business, it needs to what? It needs to create income every single month. Okay, it doesn't matter how much, how little, it needs to be in the positives. So we are now going to quickly figure out first what the cash flow is. Okay, once again, going back to the slide here, we already said in a second, I'm just going to write this out. We already said that the rent on this property is $2,600 a month. And on a monthly basis, they need to give us their monthly option consideration or monthly option money. And so as a result, they actually need to pay $33.50. Okay, $33.50. I'm going to give you a heads up. The numbers are going to be really tight on this example. I did that on purpose. Okay, just to show you. However, let's go back to the example right now first. So based on the example, the investor's mortgage right now, as we set out, investors, when we first buy this property, we got to put down 25% as down payment. Okay, and it's got a 25-year amortization. Now, some of you might be going, I just talked to my mortgage broker. If I were to back this deal, I can get it done with 20% down payment, and I can actually get a 30-year amortization, which means my monthly mortgage payment is lower, meaning my cash flow is going to be higher. However, I'm going to give you some of the more common and AKA worst case scenario right now. So 25% down, 25-year amortization, and at 5.85%. Okay, at 5.85%. So leveraging our Canadian mortgage app. Leveraging our Canadian mortgage app right now. Okay, let's go. What we're going to do here is the mortgage. Okay. Purchase calculator.
2,300.
There we go. So the home price is, as we said, we are buying this property at 486. So that's the number we punch in. Down payment is 25%. And then 5.85 is our rate. It's a 4-year deal. You can go fixed or variable, doesn't matter. Amortization is 25 years right now. And so the monthly payment is, does everybody have 2315? 2315.17. Okay, that's probably what you are looking at right now. And so in this particular case, when it comes to lease options, remember we said it's worry-free. What that really means is we budget most of the times very little to nothing for repairs and maintenance. When you go to income properties or distressed properties with Jeffrey and Ryan later on, you're going to see the different calculations. However, when it comes to lease options, we usually say that the investors are only responsible for what we call the pity payment. Because it's such a pity that we got to pay money to make money, right? That's totally okay. Investor mindset, return on investment. As long as you're making money from paying money, it's totally fine. Can we all agree on that? Yes or yes? Yes. Okay, so principal and interest, as we said, it is 2315.17. I don't know about you. I usually like to overestimate expenses a little bit. It's the Chinese in me. Okay, I very much enjoy finding a washed up and dried up $20 bill in my dryer, so that it makes me happy. And so I do that with all my deal. However, for demonstration purposes, I'm just going to round up a few cents. That's it. So it's a clean number to work with. And then taxes. Based on the slides, we said taxes is $4,800 a year. So what that means is $400 a month. And then insurance on this property is $1,440 a year. That means $120 a month. So what you're gonna get now is $2,836 as your monthly expenses. As a result, I think they should put a smile on your face very quickly right now. Is the fact that it looks like there is a monthly cash flow. You take $3,350. $3,350 is your revenue minus $2,836. You now have a cash flow of $514. I know in parts of the US, you might potentially be able to get something like this in cash flow. However, in Canada, where do you think you can cash flow on something like this, on this type of property? Most single family homes in the Canadian markets don't give you cash flow anymore, especially when it's long term. Because like I said, long-term calculations are very different, because under expenses, you typically will have to factor in seasonal stuff. So snow removals or lawn care, and then you also need to worry about maintenance and repairs. In this particular case, the tenant buyers, as I mentioned, they tend to assume, if not 100% of the times, assume the role to repair issues, because they know that one way or another, this is going to be their property that they're going to be buying and living in for a long, long time once they succeed at the program. The other thing is, the easiest way to look at it is based on these two numbers. If we already know that the fair market rent on this property is $2,600 and our pity payment is already $2,800, in a long-term rental situation, who wants to do this? You still want to do this? Because you're going to be paying your tenants to live there. Okay, you're going to be paying your tenants to live there at the very least $236 a month. And that's if your tenants are easygoing, they assume some of the maintenance and repair issues and bills. Otherwise, you're still going to have to take all those things on. Okay. And so with that said, there is 514 on a monthly basis. I'm just going to say this money is going to be coming in for 48 months. So in total, your cash flow or profit from cash flow is $24,672. Who here already likes this number? By show of hands. I know it's not big numbers. However, I want you to start thinking about if you don't have management hassles with tenants and the property, first of all, how much happier and how much easier would your life be as a landlord, as an investor? Second of all, what would an extra $514 do in your quest to create a more financially comfortable life? I know for many people, it's a car payment. It's maybe cell phone plus groceries. It's maybe your own property tax bills. However, you can build from there. Okay, it's one deal at a time. And so with that said, I'm going to keep moving forward. So now that we know it cash flows, great, it's a viable deal. Then now let's figure out how to get our tenant buyers to the finish line. Okay, to get our tenant buyers to the finish line, let's first thing first, come back to this. Remember I said there are 3 ways to make money? This is the first way. Because their $22,000 is what we call their initial option consideration. That's money that goes right into your pocket the day they agree to do lease options with you and sign the contracts. So right off the bat, by putting them into your lease options program, you get to pocket $22,000. Okay, and then on a monthly basis for 46 months, you have income of $514. And when you sell the property back to them, here's the fun part now. Okay, we're going to talk about closing. When you sell the property back, well, you're selling it at, it's already prefixed at $580,000. Okay. When you sell the property back to them, first thing first, do you own that property free and clear? Yes or no? No, I'm giving you the answers. So what that means is you still got to pay back your lender. It's a 4-year term. So based on the Canadian Mortgage app, after 4 years, the outstanding balance is $335,471. Okay. First thing first, money coming in, that is $580,000 in your pocket, but you got to pay the bank out $335,000 and change. And then what happens next is, well, you got to pay legal fees to discharge everything, to transfer the title, make sure everything is done properly and clean. And then what? One of the biggest things, like we said, we are helping the tenant buyers prove to their future lender that they have got their final down payment that comes from their total option money that they've accumulated with you. Okay. So first thing first, how much did I put down on a monthly basis? $750. Okay. And upfront, they give you $22,000. So we rebate that. And we know that's the 10%, which is $58,000. However, there is one more thing we got to take into consideration, and that is what we call the initial investment. What are initial investments? I'm going to come back here now. When we buy this property, okay, who here has purchased a property before? Either principal or investment, doesn't matter. Unmute yourselves. Okay. When you bought that property, what are some of the things that you got to pay before you even take possession of the property?
Property purchase tax.
Okay, so you got land transfer tax. Okay, I'm going to say for now, that's a variable. So I'm going to park that for a little bit, even though most provinces have that. However, in the States, they don't. So land transfer tax is definitely one of them, but I'm going to put a star on it. For most of us, obviously, to buy anything, there is a down payment. So as we said earlier, down payment at 25% down, that means $121,500. Okay. And when we buy a property, we also have to pay legal fees. I'm going to put down another $2,000. Okay. And we typically like to inspect it and have it appraised to make sure that we're not taking out a problem property or a property that we're overpaying. And these days, on a property like this, I'm gonna say $1,200 combined. Okay, we used to be doing about $1,000 these days, probably 1,200, maybe even a little bit more as well. So with that said, this is typically the money out of pocket before we acquire a property. I know land transfer tax can be there, but I'm gonna leave that as a factor for the market that you're going into. Okay, and this is why, wink, wink, nudge, nudge, typically speaking, investors don't enjoy going to provinces where there's land transfer tax for any strategy, including this one. However, that only leaves Alberta and Canada, because in Alberta, we don't have land transfer tax. With that said, though, BC, Ontario, traditionally speaking, have a higher appreciation rate. So that comes down to business decisions. So Winnie, I see you're nodding. So I understand, you're getting the thought process now. So that becomes a business decision when you're choosing your market. However, for tonight, because I'm demonstrating the principle and high level deal analysis, I'm going to leave that out for now. Okay. So what that means is, before you even take possession of this property, you got to shout out 134,700. But wait, remember, they're giving us 22,000 upfront. So that knocks that number down. So the true initial investment real initial investment really is 112,700. Okay, 112,700. And so I'm going to bring that number over now to our final calculation here. 112,700. So what we're going to do now is this. If you want to do me a favor so that we can all fact check together, I want to take out your calculators, punch in $580,000. Now we're going to subtract every line item here. Okay, first thing first, the mortgage balance, then the legal fees and total option consideration, and then initial investment. Is everybody getting 71,829 right now? Everybody? Yeah? Am I seeing any knots at all? Is the screen big enough for you? Yeah, okay, good. Well, I know you guys are looking at me on a projector, which I'm also a little intimidated by. I need to do some, poor remediation or something. You see too upfront and personal. Okay, so 580,000 divide, and you subtract all of these. You're left with $71,829. Do you know what that means? That means on the day of closing, your tenant buyers have now become successful homeowners. Can you just imagine that? Just picture what you've been able to help these people achieve. And some of them, I'm going to be completely honest with you, before they met you, they never even knew that this was possible. Okay? And then what? On that day, when that happens, they are already eternally grateful for you. And you get to walk away with a big fat check of $71,829 in your pocket. Is that a good day or is that a great day? Yeah. Okay, we're not done yet, because guess what? We got one last little step to do. We're going to look at total profit from this deal. Total profit from this deal is this number plus your profit from cash flow. We got to count that in. Okay, so what that means now is we got 71,829 plus the 24,672 that we've been collecting over the course of 4 years. So now what happens? Our total profit from this deal is 96,501. I know the marker is a little faded. Hopefully you can see it. 96,501. I'm a big fan of making things relatable back into real life. Otherwise, what's the point? We're just talking numbers, okay? Now that you know, you've run the deal analysis, you know the day you get into this deal, you are making $96,000 in the next 4 years. That works out to be just about $24,000 a year and $2,000 a month on average. When was the last time you got a $24,000 raise? And you're doing very minimal work. And you're helping somebody change their entire life. Okay, I want you to really think about that, because that's why we do what we do, and we get to do it every single day. Okay, I know some of you have been executing this strategy. The upfront is a bit more heavy. The heavy lifting happens in the beginning. However, really, it should be any sort of investment deals anyway. You should always do your due diligence upfront, because once your money is in, your money is in. Sometimes your money may be gone if you don't have any control. That brings me to my next point. You have full control over the deal. You can help the tenant buyers make changes, upgrade, update their life. And if it all fails, knock on wood, worst case scenario, you still have a piece of hard asset that you have full control over. Okay. So I want you to really remember that. So I see there's a hand up, but I'm going to address Q&As at the end. Okay. I'm going to power through this first so that we finish the entire calculations. So here is the next step. We always say we want to make money. Great. We know we're making money already. It's a viable business because we're making cash flow on a monthly basis. Now, the second question typically, and what we call it really, is the second priority as an investor. First one is cash flow. Okay. If it doesn't cash flow, it's not a viable deal. You may want to move on. Now, if you are at a different stage as an investor, for example, myself and Ray, we sometimes will now acquire properties for pure equity gain / tax purposes. So cash flow, if it's just cash flow for $1 or $5 on paper, we are okay with it. However, like I said, it's not going to be in the negatives. Because the moment you're in the negative on a monthly basis, you become extremely financially vulnerable to any sort of economic conditions. Okay. Now, last but not least, you want to calculate your return on investment. Because now that you know it's a viable business, great. There are tons of viable business opportunities out there. What makes you pick one over the other is how hard is my money working for me if I'm an investor, okay? So when I'm an investor, I want to know. So return in this case is 96,501. Our initial investment is 112,700. There is your math. So take out your calculators one more time. 96,501 divided by 112,700. You get a number, then you multiply it by 100%. So that means this deal overall is making 85.62% over 4 years. So on an annual basis, and I want to stress the fact that this is what we call a cash on cash return. Cash on cash return. Okay, it's a simple interest calculation because we are taking the overall return on investment number and dividing it by 4. That means 21.4% return on investment on an annual basis. So I'm going to do a quick exercise with everybody. If you're writing right now, it's a time to put your pens down. First thing first, by a show of hands, if you like the idea of helping people succeed in life. Awesome. You can do your emojis too. Okay. I see some of you guys still don't have your cameras on. Again, if it's a safety issue, I understand. If not, please participate as much as you can. Okay. Or use your emojis. So I know you're still there and you understand everything we just went through for the last 90 minutes here. Okay, second question. By a show of hands, if you like the idea of adding $514 into your monthly income by doing very little to no work? Okay. Next question. By a show of hands, if you like making $96,000 in addition to whatever income streams you already have over the next 4 years. Last but not least, by a show of hands, if you like the sound of over 20% return on a piece of hard asset that you have full control over. And everybody, there you have it. This is a simple lease option deal analysis. There are a lot of different factors in different markets that you need to take into consideration. However, I want to let you know, this is why tonight we named it Is Now a Good Time? Is now a good time to invest in lease options? The answer is always yes, when you do it this way. Do you know why? Because it's tenant first. It has nothing to do with the properties. It has nothing to do with the property values, because you can pick markets to go into where the numbers make more sense. It has everything to do with the tenant buyer's ability to debt service and to exercise their option to purchase. Okay, so what that means is, if you're leveraging this strategy, make sure you still check with your mentor. Okay, if you're leveraging this strategy, all you're doing right now is look for somebody with at least these two things checked off. Number one, becoming homeowners is very important to them. There is a huge emotional anchor tied to that. There's pride, there's joy, there might be even cultural factors. However, you want to find them. You want to find somebody that knows what it means to become a homeowner, first of all. Second of all, which is reality speaking, they need to be able to debt service $3,350 on a monthly basis and coming up with $22,000 upfront based on this deal. Okay. That's it. You are just looking for people that will check off at least those two boxes. If you have more business decisions after you've taken the courses later on, or while you're working with your mentor and the mentor is now able to assess your personal risk tolerance level, they might put in more parameters for you and with you, okay? However, on a high level, this is what it is. And so I will now take a couple of questions because I have something else I really want to share with you. Okay, so first question, Miranda, do you still have your question? I know your hand is not up anymore. Yeah, talk to me. And I know next is Richard.
Is it the 135, 134, 700? Shouldn't it be 124, 700? Do I see that wrong?
It's 121 plus 2.
Is it 121 plus 2,000 plus 12?
Where is 121? Down payment?
Yeah.
Yeah.
Plus the 2,000?
Plus
Oh, wow. Yeah, you know what? You're right. Actually, that's a happy mistake. You are absolutely right. Thank you. So it's actually 124, 700, right?
Yeah.
Awesome. Thank you. So when you take out 22,000, it's actually 102, 700. Man, thank you for making my deal look even better now. So that means, look at that. Remember, I like finding money.
Free Starbucks.
And so what that means is your total profit is now 106,000.
Hey, we can go on vacation.
Exactly. 106,000. I want to make sure that initial investment is 102,700. Okay, so 102,700. And so what we have now, I could kiss you right now. Okay, here, 106,501 divided by 102, 700. You are now at, I'm just gonna write it up here, okay? Up here. 103% over 4 years. So that means you're almost at 26%. So 25.92% return on investment every single year. Thank you for catching that. Happy mistake. There we go. The numbers got even better. Is that the only thing you wanted to point out?
Yeah.
Yes.
Okay, awesome. Thank you so much. Okay, Richard.
Hello. Okay. So I have so here's my question. I'll try to put it as succinctly as possible. I'm interested in your opinion, Tim, and everyone else can pitch in everyone's opinion about navigating dynamics between couples when it comes to qualifying for tenant buyers, and especially when it comes to getting them to pay commitment fee. And I have two school of thoughts that I heard. One is get them pay as soon as possible. It will figure out the rest along the way. A lot of these people, they don't know what they want, so they need to chat themselves up and see the options. So that's one school of thought. The other school of thought is, make sure they're really aligned before you charge them, before you push it to the mortgage broker. Run their financial analysis maybe preliminarily before you push it to the mortgage broker. Since we are early in the process, in the lease option investing journey, we're leaning towards the second school of thoughts, which is to really wait for that alignment between the couples. Jesus Christ, they're taking their sweet time. So that's a long question, but I'm interested in your opinion on this, Tim, and everyone else's.
Well, I'm gonna let somebody else speak because I have a lot of things to say about that. Having been executing the strategy for almost 12 years so far. Anybody's got any take on it? I know, Jalal, you've executed the strategy before. If you want to share something, your perspective, anybody else?
Yeah, I can share my experience. In fact, I have been seeing a lot of couples. Having alignment between the two couples is very, very important. If you don't have that alignment, deal is gone. They will find one of the couples who is not aligned. He will find any reason just to destroy the deal. Second thing, really having the commitment fee as early as possible will now show that that alignment is there or not. And that will really save the time for you or for them. So really the commitment fee is very important. I have tried different ways, but I found out if there's no commitment fee, things can really just not work well, and they will disappear without any reason. This is my experience.
Absolutely. I totally agree with you, Jalal. Thanks for pitching in and sharing. And this is why the funny thing is commitment fee was actually not a thing even when Ray and I were students. That commitment fee that all of you are talking about and have heard of, I actually came up with that. And as I don't say it as in I came up with that. I was completely surprised at the beginning of my career that nobody even thought of it, because I came up with the commitment fee after losing my voice, answering 50 plus calls in less than a week, explaining how rent to own works to the people that responded to our ads, that we run lease options programs or rent to own programs to help them get into home ownership. And then very quickly, like what Jalal was alluding to, is the fact that when there's no skin in the game, you are wasting your own time and their time. There are a lot of tire kickers out there. And that's why earlier I did say, you know what? The two things that you're looking for, the two types of people, or the people that you're looking for need to check off these two boxes. The first one is home ownership needs to mean something to them. There needs to be that emotional anchor that they share together. And so that means money becomes secondary. And exactly, money is secondary because then you get to take them through your process now to qualify them on a numbers basis. No different than why we do what we do is that there is a why, there's a purpose, there's a reason behind it. And the reason is that it could be a cultural thing, it could be a personal aspiration thing, it could be an ego thing, and it could be a pride thing. They just want to become ownerships, and they're pretty much willing to do whatever it takes, given that they are able to financially. So
But the answer is simply, oh, it'll be nice to own a home. I don't know. That might
those
not
are
necessarily.
not your tenant buyers.
Okay.
Yeah. So the examples that I sometimes give is, if it's kind of like, would you like fries with that attitude? Let's say, you go to McDonald's and you're ordering a chicken sandwich, and then they're like, do you want to combo that? Do you want fries with that? And they're like, oh, why not? A why not is not a why. Okay. That means they're not committed. When they're not committed, that means they're flexible. When they're flexible as the investor facilitating the program, means that you're going to be going out on a goose chase once every so often, even if they do go through the initial process. And sometimes, you know what? I mean, in the beginning of our career, because we were willing to do whatever it takes to get deals done, our screening process wasn't as tight as it could have been. So we did have tenant buyers that demonstrated the willingness and the why. And they even put down the money that we were asking them to put down, and they could debt service. However, some of them a few months in, some of them probably a year in out of a 3-year program, they changed their minds because they were not committed in the first place. Okay. And so it all comes down to commitment, no different than all of us committed to our own financial success, starting with financial education. So, yeah. Hopefully that helps. Now I'm seeing the chat box light up a little bit. Hang on a second. I want to make sure I'm not missing anything.
So Tim,
Yes.
when you say to get the commitment fee as soon as possible and that you wasted so much of your time answering questions, do you then ask for it before you like answer all their questions, or like at what point do you ask for it?
Yeah. So Suzanne, if you remember when you went to the lease options class with Rolando and Lilium, or one of them, or both of them, is the fact that there's a package and there's a FAQ that they've already shared with you, that a lot of the students, they basically just use that. So frequently asked questions can be easily handled. However,
Right.
one-on-one questions, yes, you know what, you do spend the time with them, because the other thing is it becomes a business decision. How much time do you want to spend with them before you collect the money? Because the commitment fee, again, as you've learned from the class as well, is that it's also a business decision. If and when they do not qualify or they don't want to go through with it after the commitment fee is being collected, do you provide a refund? And if that refund is 100% or a portion of it, because your time needs to be compensated, and maybe even your power team's time needs to be compensated as well. So that's a business decision that you're going to have to make. Now, I will usually say that most people will, if they're asking the right questions, it really doesn't take you any more than an hour to figure out whether or not they're serious or just doing some initial research. Okay. And that's why the questions I always like to ask is not, how did you hear about us? Don't get me wrong. It's important when you're spending marketing dollars, you want to see what's effective and not. However, the first question is, tell me what being a homeowner means to you. So tell me why you decided to have this chat, this conversation with us, or with me for that matter. Okay. I want to hear things like, oh, you know what? Like, we've been saving up for the last 5 years. And then every single year when we just thought we were ready, we go to the bank, we go to the mortgage broker. They always came back and say, no, this is missing. That's still missing. We're just tired of hearing no. And now we're thinking there must be other ways to get it done. Right? That persistence, that resilience that they're demonstrating, even outside of you and prior to speaking to you, those are all little indicators.
Okay, thanks.
Yeah. And going back to the chat box, Winnie, right? What if the tenant does not qualify for the mortgage at the end of the 4 years? There are options. So, and this is why when I said in the beginning, this is lease options. I know some people, they say rent to own. Rent to own isn't that lease option only. And you'll see some other courses, I'm not going to name names. You've probably come across courses where they just teach rent to own or lease options, or lease option, singular. It means that when they are teaching you how to use the contract or create your own contract, or how you can work with your lawyer to actually make that contract for you based on your business decision and your risk tolerance, none of the other options are taken into consideration, because most of our option to purchase contract, we also have clauses on option to renew, option to delay, option to extend. Those all should be in there. Now, if the tenant buyers are saying, no, we're not able to, we don't want to, for whatever reason, you're not going to force it on them, because what you're doing is you're giving them a first right of anything. And if they refuse the first rights of anything, then that's fine. As we said, 4 years later, you've probably got a good chunk of principal pay down. You now have a piece of hard asset in your control, because now the lease is done. They need to move out, or they don't have to move out. You can raise the rent. They can just be tenants. We've had those scenarios where tenant buyers, a year in, 2 years in, they say, you know what, looking at our situation, we just think that we might be too house poor after we buy it, or we feel like we've been house poor being in a lease option. We just want to rent now. So if the numbers make sense to you, you can transition them too. So there are a lot of things. And I forgot who your mentor is. So make sure you talk to your mentor about these questions, because they would know, again, your risk tolerance level a little bit better, and what your concerns are and how they can help you structure those things. However, it's never the end. And there are, there's one story that I share quite a few times, because they're just stories that really stick out to you as in experiences. And this particular one is basically, husband is a truck driver, wife is a nurse, and they have 4 children. And this was an Edmonton deal back in 2012, like really, really early on in my investing career. And so we put them into a lease option. They qualified, they were fast with paperwork and then paying their commitment and then paying their initial option. Everything was great. We moved them in, they make their monthly payment on time. About 6 months in, we get a call. And basically the call is, the wife has just been diagnosed with cancer and now she needs to be treated. And so what that means is, initially she's not going to completely stop working because it wasn't that serious yet, according to them. And so again, it became a bit of a trickling effect or domino effect, because she needs to go into treatment. She's cutting down on hours, which means her paycheck is now decreasing, which means it now feels financially heavy for them to manage the day-to-day. However, because she now needs to go into treatment and she's a bit more tired and she needs to recover, the husband also now needs to take on less shifts to deal with the kids. So overall speaking, it just became really, really heavy for them. So they basically called us and said, you know what, we're going to keep renting because we love the house. It's close to work. If the kids are going to school already, we're just going to rent. And at that point in time, for us, it was an easy decision to make. Okay. So we said, yes, we'll rent it to you, because the rent was actually more than the pity. We did negotiate with them to say, hey, you know what, if you can take care of the maintenance and repair issues, the day-to-day stuff up to $200, then we're okay with that. And they say, no problem. And then that went on for a couple more months. And then we got another call saying, you know what, the treatment's not working. And now she needs to completely be off work so she can do a surgery. But then as a result, they get some government support so the kids can be looked after. And yet at this point, he's going, well, you know what, this is not sustainable, because it's not just the rent. We're also having a hard time paying our regular bills and putting food on the table now. So I got to pick up more shifts. But my existing company does not pay me well. And I just got recruited by another company who's going to pay me a little bit more. Long story short, he basically needed to move out of the Edmonton, because if he doesn't, then the commute to get to the workspace to pick up the truck, he's the truck driver, is an hour and a half each way. And so that doesn't make sense for him on a daily basis. So long story short, we basically said, okay, you know what? If you think that you're going to be uprooting your entire family out to that new city, we will honor all the option consideration that you paid up until this point, and then we're going to move it into another rent-to-own property for you. Is that something you want to do? And they say yes. And then it still ended up being a happy story. because she recovered from cancer. She's went back to work. He's now working. They bought a house 3 years later. Everything was good again. However, things do happen, right? So it's this business decision that you get to make, because we didn't have to honor their option consideration, because the way the contracts are written usually is it's non-refundable if it's your own decision. Okay, if it's things outside of your control, we get it. Cancer is outside of their control. However, they made the decision to give up on the program. And you know what? As I'm talking about this also just reminds me why we are private investors, because we get to treat people like people. They're not just a number. We get to really assess individual cases and make business decisions accordingly. So, I mean, that's a much bigger answer than you asked for, but hopefully that kind of gives you some, some ideas and thought process in terms of how flexible you really can be. And this is one of those strategies where you can really put your personal stamp on it. Your values, your heart, business decision, being profitable, they can all exist at the same time. And that's what's cool about it. Yeah.
Thanks, Dan.
Yeah, of course. Okay, Richard, one more and then I gotta move on.
I don't have to talk now if someone else has questions. I just put myself in the line. That's it.
Well, you're next in line, so go ahead.
Okay. How do you usually make business decisions around tenant buyers that want duplexes, saying they want to live in one and rent the other? My thought is that maybe we also need to vet their ability to become landlord, but I want to hear your thought on that.
Yeah, absolutely. My answer is actually very simple. So 2 prongs. Number 1 is I like to keep every deal clean as possible. So today I would not allow them to be a landlord. Okay. However, again, when we first got started, we did allow some of them to do it that way, because the additional mortgage helper with the additional income really helps them with qualification at the end, first of all. Second of all, on a monthly basis, it does ease up. And so we did have to come up with a structure where we actually are the landlord of both tenants. However, the tenant buyers need to be aware of the fact that no matter what happens with the other renter, they are 100% responsible for the entire RTO payment on a monthly basis. So if you can think about it this way, what we ended up doing is we will always charge the full amount in this particular case for $33.50, okay, from the tenant buyers. And then we will charge, let's say they rent out the other side or the basement for $800 or $1,000. We collect both, and then we refund the $1,000 back to the tenant buyers. Okay. Now we've done it in the case where that $1,000 does not go back to them in cash on a monthly basis. It becomes their additional option consideration.
Okay. Very interesting. Yeah.
Yeah. So again, it just comes down to how you structure that. And the first thing I will tell you is they are not your sub-landlords. They are tenants. And most of them barely qualify to be landlords. So yeah. Okay, so with that said, yeah, of course, I really want to share a few things with you all. As you know, we are very, very active in pushing our mission forward and spreading financial education as much and as widely as we possibly can. So I know some of you, or most of you, have already had the TYT experience, and I hope it's been enjoyable. And if not, talk to me. The thing is, we are going to be running a live workshop in Edmonton, and that's 2 days in length. If it's something that you are interested in, make sure you go to our Eventbrite page, which I will actually copy and paste now and share with you in the chat box so that it's a lot easier for you to find it again. So our Eventbrite page has all the upcoming events. These are just some of the highlights that I'm putting down for you. And what we're doing right now is a special, which I will walk you through as well. And then every single month, we have a Saturday coffee chat about real estate, about money, about investing, about money mindsets, because ultimately speaking, we are not just real estate investors. We are investors through and through, meaning we are learning how money works and how money can work for us in our advantage for the rest of our lives. It has never been just about buying properties. It's not about learning a couple of strategies. This is a long-term thing, okay? And this is why we have mentorships rather than coaches. You'll have strategy coaches that will guide you in the initial process on choosing the best program that will fit your financial goal. They will tell you what you need to do, because that's what coaches need to do sometimes to hold your hand to that point. And then you start working with a mentor, and mentors, they get to learn about who you are. And more importantly, like I said, as investors, your risk tolerance level and your financial goals, so that they can put it all together for you in the long term. It's not get rich fast. However, it's get rich for sure with us. We've seen it time and time again now, and TYT has been around for 3.5 years. We have now created dozens of financial independent people and family and financially free cases as well. So with that said, we're also going to be running quite a few TYT Connects. So these are usually the fun events. It's a networking event. It's open to the public. You can come meet us, meet the team, meet our other students. And most of the times we hold these at restaurants. So it's very casual, because we just want to really build that community and that TYT family, as we call it, where we are really there to support each other's growth at all times. And so there are a few upcoming ones. The dates have been chosen already. The location will be announced. So I hope all of you are all on our mailing list. And if not, on Eventbrite, the moment the locations are determined, you will be able to actually know where they are and where to go and register for them. Some of the TYT Connect events, there is a limit to it, simply because of the space and the restaurant requirements. So Edmonton is coming up May 20th. So mark your calendar. If you're in Edmonton or going to be in Edmonton, you can come and meet us. We are real people. I know these days, things have pretty much completely opened up. However, during COVID, everything was pretty much done online. And some people were going, is TYT real? Are these people real? We are very real. And so we're going to Ottawa on June 1st. We're going to be in the Kitchener, Waterloo, and Cambridge area, Ontario, on June 3rd there. And then in London, Ontario, we're going to be on June 7th. And then we have Calgary and Vancouver in the works right now. We actually just had a Vancouver TYT Connect about 2 weeks ago. So all these things are happening across the country so that you can get to know who we are. Come and meet TYT trained investors and know the difference for yourself. Because at the end of the day, we are training people that will become financially well off, financially confident, financially well and healthy. And more importantly, there is no more stress about money. Okay. I jumped the gun and did the open Q&A already at this point. So I want to encourage all of you, if you have not been to a workshop or a boot camp yet, take that leap of faith. Take that leap of faith and bring yourself into a boot camp or a workshop that is coming up, that's put on by Trust Your Talent. Now, I'm going to share this with you, is the fact that if you are not wanting to wait because you're like, you know what, I'm ready, I want to take action, I want to do something, book a coaching call right now. Let a strategy coach guide you through what the next steps are. Because I know sometimes it's one of those things. We all want to become more resourceful. We all want to make more money. We all want to make sure that money no longer becomes an issue in our life or a stressor over time. However, we don't know where to start or how to start. This is how you start. Okay. Book a call, and to make it easy, there is a QR code. So you can grab your phone right now, take a quick scan, and go and book a strategy coaching call. Strategy coaches will basically get to understand right off the bat where you are right now and where you want to be, and help you plan the steps to get there. Okay. They basically function like a very, very financially intelligent GPS, in my opinion. So, and they're some of the smartest people that I know, honestly, in this industry. And so make sure you book that call. Now, I know we got upcoming events already. I already shared that. So what I'm going to do here is to share with you the workshop in Edmonton, what it's going to cover. Okay, right off the bat, it is about strategic real estate investing fundamentals. Now, this needs to be updated. It's a 2-day event, as I mentioned. I'm sorry, this was not updated properly. So it's a 2-day event. It's 9 to 6 on both days. Okay. So as you can see now, we've actually expanded the workshop because we really want to make sure that you don't walk away from the workshop confused or having more questions, because sometimes that's what happens when the sessions are a little too short. So we have 2 full days coming at you 9 to 6. Make sure you check Eventbrite. However, the details coming up are accurate. So what can you expect? In any sort of investing or business building journey, you have hard strategies and you also have what we call soft strategies. It's important to learn the hard strategies because that's exactly how you know you're going to make money. You're going to get the step-by-step guides for every single strategy that you go into so that you can execute them. However, soft strategies such as creative financing, asset and income protection, those are things that are what we call soft strategies that are just equally important, if not more important. For example, raising funds for your business. Who here thinks that they have unlimited resources right now to build their portfolio? I don't think any of us really does. Okay. And this is why raising funds is one of the strategies and one of the skills that I value and cherish so much. And that's not a hard strategy. There's a lot of understanding on negotiation and presentations, structuring deals, and how you can present the deals effectively so that your money partners will say yes to you whenever you got a viable deal. By the way, at this point, I want to share with you, there is a difference between opportunities and deals. So I'm not quite sure you picked up on that during this entire webinar so far. It's the fact that opportunities are everywhere and they're not always great. So a deal is an opportunity that you have put through your deal analysis process. And your deal analysis process, remember, includes your business decision and your personal risk tolerance level. And that typically means that you will have a much better idea on those factors after a mentorship for most of us. Then you can actually say, you know what, I got a deal that I can present. Now I got to raise funds. And so with that said, in addition to all of that, we want to make sure that it's not just 2 days of you sitting there doing nothing. There are going to be interactive breakout sessions. There are going to be small group discussions. There's actually going to be cash flow games. I personally love leveraging the cash flow game, if you've never played it before, to demonstrate the principle of financial education, leveraging real estate investing. By the way, I'm going to be the main trainer for this live workshop in Edmonton. Existing students, you are already invited. If you've never been with TYT, I'm going to share with you how you can actually get your ticket and participate that weekend as well. We're going to share contract templates with you. What that really means is where's the value in that? We're going to walk you through the contract clauses. We're also going to show you what it means financially speaking. And if you've heard of the phrase billable hours, you understand having some sort of contract templates that you understand and can already implement in your deals, that will literally save you thousands and thousands of billable hours right off the bat. And then with that said, raising funds scripts are going to be shared. Course materials and recordings, you're going to have access to it, and scholarship opportunities because we are an academy. What that also means is none of the trainers and mentors are allowed to do deals with students. We are 100% education only. We're going to give you everything we possibly can because we're not one of those organizations that teach you just enough so that we come to you and you become our OPM. That's not what this is about. We want to teach you how to fish so that you can feed yourself for the rest of your life. And then you're going to get access to our core courses and unlimited online live bootcamp refreshers in 2023. Because sometimes we understand the first go around, you don't always pick up everything. This applies to everything else in life, even as simple as maybe a TV show, maybe a movie. Anybody's watched a movie for the second time and you're going, oh, I missed that part last time. Can you imagine the power of being able to do refreshers on financial education over and over and over again? There's always going to be nuggets and aha moments that you will take away. And that's why you only make that investment once and you get to benefit it for the rest of the year. So this whole thing for 2 days is typically valued at just about $10,000. However, because you are on this webinar right now, we are running a special for you. And it is only $199.99 per person. Now, we understand a lot of the times you want to get your significant others, your spouses, your business partners. Your business partners could be a coworker, could be a cousin, could be other relatives, best friends. You have the same dream. You want to do something together about your life and your financial situation. You want to come as a pair. We're not going to charge you twice. Bring a friend for only an additional $100. So what that means is we've seen families, parents bring 3 kids with them. So it's $199.99 for the first person, and each additional is only $100. So I want to make sure that I clarify that in case that's what you're planning to do, or you got people that can come with you. And I know sometimes some of you are very, very smart with money, right? In that example, 5 people means, let's just round it up to 200 plus 400, 600 divided by 5. That's 120 each. So the main person, instead of paying $200, they will say it's 120 per person. Let's go. Okay. Space is limited simply because we have to rent this. We have to rent a physical space now, which is cool and fun at the same time, because the safety and fire regulations, they will always be a room cap. So make sure that you register yourself if this is something that you want to do. It's happening once again, the weekend and Saturday, Sunday of May 20th and 21st, which means it's a long weekend in May. You still got Monday off after, okay, Canadians. So with that said, act now, register now, and go to Eventbrite. So last but not least, I just want to say a quick thank you for spending the last 2 hours here with me. I know I'm about 3 minutes over time right now. However, thank you. If you have any questions for myself or for Trust Your Talent about Trust Your Talent, make sure you reach out to us. Okay, very, very simple. The email here is support@trustyourtalent.ca. You can reach our team at any time, or once again, go online and book an appointment and speak to a strategy coach. They should be able to answer every question that you have about the curriculum, about strategies, supporting you on a quick deal. However, remember, one thing that we really don't enjoy doing is training you enough so that you're dangerous to yourself. And a lot of people do that to themselves without knowing it. Okay? Remember, this is a journey. Have some patience. However, when you do the work, the results will be solid and it will come. It'll feed you for the rest of your life. So with that said, thank you so very much again. Have a great evening, everyone. I'm going to end the session now and talk to you soon, one way or another. Bye, everyone.
Thank you.
Thank
Have a good
you.
night.